Will the wave of pending office real estate loan refinances precipitate a real estate crash? The majority of commercial real estate loans originated in 2018 through 2020 have repayment terms of 5 years or less. So let that sink in for a second. Real estate loans made pre-pandemic that were made in an environment where office was the safe darling of commercial real estate are now coming due in an environment that is anything but. In 2023, borrowers looking to refinance office real estate loans are likely to face significant challenges, including higher interest rates, stricter loan standards, and reduced asset values. These factors are contributing to a growing debt funding gap that may require borrowers to bring cash to the table or sell their assets. The credit quality of older office buildings is also causing concern, which could lead to further declines in asset valuations. Can you see how this could be like a spiral of asset valuation decline? So lenders, especially those with higher exposure to buildings, may need to reassess their office real estate portfolios and conduct increased scenario analysis due to the uncertainty surrounding the future performance of office properties. With prices for office buildings already declining, this debt funding gap may cause prices to accelerate in this decline. So borrowers with loans coming due are facing the twin challenges of higher interest rates, tighter loan standards from banks, which are now requiring lower loan-to-value ratios. So coupled with declining valuations, this may necessitate additional cash from borrowers to refinance their loans. I know we've already covered this, but this is super important, especially if one, you own an office or you're an investor and the refinance is part of the play. There may be capital calls involved. So this debt funding gap is expected to emerge this year and persist through at least 2025. So as we've discussed on this channel before, this is just starting. Now, as the maturity of loans originated between the 2018 and 2020 period have repayment terms of 5 years or less, we're not expecting this to go anywhere anytime soon. Now, if borrowers cannot supply the necessary cash or negotiate loan terms with lenders, foreclosures and distress sales, we're going to be on the rise. So this is going to put further pressure on downward valuations, particularly for older, non-luxury office buildings. Private equity funds that target distressed assets may not deploy their dry powder without a substantial drop in valuations, and that's what they're expecting. So this is really what's happening in this challenging financial environment. Although commercial real estate delinquency rates remain low, lenders are really starting to feel the impact in certain geographies. The share of really criticized loans are in New York, San Francisco, Chicago, Boston. These markets, these delinquency rates have risen into double digits according to CMBS data. Some banks are reviewing the sponsors, the tenants, and location of every office loan in an effort to measure this risk in the space and determine whether to keep the loans on their balance sheet. Guys, we're on the knife's edge here. We may be able to pull back from the brink, or a wave of bad news could lead to a downward spiral of lower valuations, reduced lending, lower valuations, keys handed back, lower valuations, reduced lending, etc. Watch this space. If you don't want to miss an update, subscribe below. And also, you can sign up for our weekly newsletter where we cover all of these articles and trending thoughts every week at thelimitedpartner.com/news. Let's stay in touch, let's watch this space, and we'll talk to you soon.